In 2024, tens of millions of Americans are on the brink of financial collapse, with many barely scraping by. The dollar, which has lost 95% of its purchasing power since the 1970s, has seen a sharp decline recently, making it harder for households to keep up. While wages remain stagnant, bills continue to mount, leading to an alarming rise in debt levels. At the same time, savings accounts are dwindling, placing thousands of U.S. banks at heightened risk of failure. American families are being squeezed from all directions, and the financial outlook looks increasingly bleak. Conditions today eerily mirror the lead-up to the Great Recession, with higher living expenses and limited access to credit putting families in a vice. In this video, we're going to reveal 7 shocking signs that show just how close everyday Americans are to breaking financially. Number 7. Declining incomes force households to borrow more. In recent years, American households have faced unprecedented financial challenges, with average incomes steadily dropping while the cost of living continues to rise sharply. According to a study by SMB Nikko Securities, household incomes have fallen by almost 10% in just 4 years, with a staggering inflation-adjusted decline of 99.1% since April 2020. This plunge in income is hitting consumers hard, especially as the prices of basic goods and services soar at more than twice the rate of income growth. As a result, many Americans are increasingly reliant on credit to cover everyday expenses. A survey by Assurance IQ highlights this trend, revealing that 66% of U.S. adults, even those earning $75,000 or more per year, had to make sacrifices to afford their expenses in the past 12 months. Notably, 41% of those surveyed reported needing to borrow money to pay bills. The strain is even more pronounced among lower-income earners, with 47% admitting they had to turn to loans to cover essentials over the last year. These findings underscore a growing economic pressure faced by households across income brackets, where dwindling wages and rising costs create a cycle of financial insecurity. Number 6. The Great Debt Trap. Credit card debt and interest rates out of control. Credit card debt in America is surging to levels unseen in decades, with the average credit card debt per household reaching $8,674 in 2023. This is the highest since 2003 and a substantial leap from pre-pandemic levels. In late 2019, the average household carried $7,499 in credit card debt. By 2021, stimulus payments had brought that figure down to $629, but 3 years of inflationary pressures have since driven a dramatic $2,200 increase. Today, total credit card debt in the U.S. sits at a staggering $1.14 trillion, up 5.8% from 2023. Compounding this burden is the unprecedented rise in credit card interest rates, currently averaging an alarming 22.76%. For millions of Americans, this high interest rate creates a financial trap, making it nearly impossible to pay off debt while keeping up with interest charges. While consumers who manage to pay their balances in full enjoy the benefits of rewards and purchase protections, those who are unable to pay in full face a cycle of escalating interest and debt. Credit card companies, meanwhile, are reaping record profits. Rakeem Moore, chief economist at the Groundwork Collaborative, points out that companies are capitalizing on inflation to justify these high rates, leading to an extra $25 billion in profit margins over the past year. This inflation profiteering drives interest rates beyond the Federal Reserve's high benchmark, burdening households even more. As Americans grapple with rising prices and stagnant wages, the record credit card debt and surging interest rates underscore the need for systemic change, including more transparent lending practices and supportive policies for consumers. Without intervention, the cycle of debt may become an even greater crisis for American households. Number 5. The surge in emergency 401k withdrawals, a financial lifeline for struggling Americans. In an era of economic uncertainty, More Americans are tapping into their 401k accounts as a last resort to cover immediate financial needs. Bank of America recently reported a staggering 36% increase in emergency withdrawals from these retirement accounts year over year, with the number doubling since 2021. The reasons behind the surge are largely tied to the financial pressures of rising housing costs and economic instability. Many individuals are resorting to these emergency hardship withdrawals to prevent losing their homes through foreclosure or eviction. The financial strain of skyrocketing mortgage payments, inflation, and other cost of living pressures has left households with few options. For these families, withdrawing from their 401k plans represents a crucial decision, sacrificing long-term savings for short-term survival. While this can provide immediate relief, it also carries the potential to undermine their financial future, making it a decision fraught with consequences. This trend reflects a broader issue facing the American middle class: the gap between income and the skyrocketing costs of housing and living. The reality is that emergency withdrawals from retirement accounts are becoming a necessary response to prevent financial ruin, with many households caught between the need to secure shelter now and the risk of jeopardizing their future financial security. Number 4. Soaring mortgage payments and down payments. The housing market in America is undergoing a drastic transformation, with mortgage payments rising to unsustainable levels for many families. Zillow reports that the average mortgage payment in the U.S. has surged by an astounding 96% over the last 4 years. From an average payment of $1,329 in 2020 to a staggering $2,650 in 2024. This increase has put homeownership further out of reach for many Americans. The reasons behind this spike are multifaceted. Rising home prices, inflation, and higher interest rates have all contributed to the growing financial burden. On top of the ballooning monthly payments, the price of homes has also skyrocketed, making it increasingly difficult for potential buyers to save enough for a down payment. In major metropolitan areas, an average down payment now exceeds $127,000, an amount that not only strains the finances of middle-income families, but is also a substantial sum for wealthier households. For the average American family earning a median household income of $74,000 annually, this down payment now represents nearly one-third of the median home price and is almost double the annual income. This reality underscores the growing disparity between wages and homeownership costs, forcing many families to put off buying homes or to consider more extreme financial measures, such as tapping into retirement funds or taking on high levels of debt. In this environment, the dream of homeownership is slipping further away for many Americans. The rising cost of living, combined with the difficulties of securing a home, highlights the ongoing financial struggles faced by a significant portion of the population. Whether it's withdrawing from a 401k or facing insurmountable mortgage payments, the financial burden is becoming unbearable for countless individuals and families trying to navigate an increasingly expensive and uncertain future. Number 3. Rising energy bills. As the colder months approach, one of the most pressing concerns for American families is the rising cost of energy bills. According to recent reports, overall energy costs surged by 4.3% last season, and with winter on the horizon, consumers can expect even steeper hikes. A CNET Money survey revealed that over 78% of U.S. adults are already anxious about their home energy bills, with a startling 32% resorting to financing options like credit cards, loans, or payment plans just to make ends meet. In addition, roughly 24% of respondents are scaling back on essential purchases, like groceries or health care, in order to cover their energy expenses. This uptick in energy costs can be attributed to a variety of factors, including increased demand during the winter months, the rising price of natural gas, and ongoing supply chain disruptions. With inflation already weighing heavily on household budgets, these mounting energy costs add another layer of financial strain, particularly for those living paycheck to paycheck. As energy providers adjust their rates in anticipation of the winter demand, the fear of high energy bills is pushing many to reconsider their spending habits and seek alternative ways to keep their homes warm. In this context, the financial burden of rising energy bills is not just a temporary inconvenience, but a long-term concern for millions of Americans. With many turning to credit options to manage their energy costs, this cycle of debt may worsen as the winter months unfold. The challenge, therefore, isn't only about how to reduce energy consumption, but also how to make energy bills more affordable and sustainable for the average household. 2. Banking crisis looms, record losses and plummeting credit scores. In recent months, U.S. banks have faced a troubling trend, record losses driven by rising credit card delinquencies. According to the Federal Deposit Insurance Corporation, FDIC, these delinquency rates reached 10.9%, the highest level in 12 years. Major financial institutions like J.P. Morgan Chase, Wells Fargo, and Bank of America collectively wrote off $5 billion in bad debt in the second quarter of 2024, signaling the challenges of a consumer base increasingly unable to repay debts. This wave of delinquencies has also led to a significant shift in consumer credit scores, which have fallen for the first time in over a decade. As savings rates dwindle and more consumers struggle to meet monthly payment obligations, the result has been a historic dip in creditworthiness across the country. Ethan Dell, FECO's Vice President of Scores and Predictive Analytics, described this trend as a notable milestone, explaining that, for the first time in well over a decade, the score went down. Dell further noted that many Americans have exhausted the financial cushions they once relied on, leaving them vulnerable to the pressures of mounting debt. These financial struggles reflect the broader economic challenges facing many Americans today. With rising costs of living and stagnant wages, more consumers are turning to credit just to make ends meet. As debt piles up, so does the strain on personal finances, creating a cycle of missed payments and declining credit scores. If this trend continues, it could impact consumer access to credit, exacerbate financial insecurity, and further strain the financial industry in the years ahead. Number 1. The soaring cost of car repairs, an unseen financial strain. While rising energy bills are a major concern, another growing financial strain for American families is the skyrocketing cost of car repairs. The price of both new and used vehicles has already soared in recent years, and this trend is compounded by the financial strain of auto repairs. According to the Bureau of Labor Statistics, car repair costs surged by nearly 20% in 2023, marking the largest annual increase of any household good or service. For motorists, this is not a luxury expense, but a necessity that is becoming increasingly difficult to afford. The skyrocketing costs can be attributed to several factors, most notably the shortage of skilled auto mechanics and repair professionals, which has driven up labor prices. Additionally, the price of automotive parts has also spiked. For instance, while car batteries used to cost under $100, they now average close to $200. Parts from automakers have seen a 10% price increase, and aftermarket components have surged by an eye-popping 177% in just the last year. In comparison to the typical inflation rate of 0% to 4% for household goods and services, the automotive repair sector's price hike is glaringly steep. These skyrocketing repair costs place a significant burden on consumers, many of whom are already dealing with the financial fallout of high interest rates on auto loans and insurance premiums. For many Americans, a vehicle is essential for commuting to work, attending school, or fulfilling family obligations. The inability to afford necessary car repairs can lead to a cascading effect, forcing individuals to miss work, lose income, or take on additional debt just to maintain their transportation. As car repairs continue to climb in cost, it becomes clear that these financial strains aren't isolated incidents, but part of a larger pattern of escalating expenses that are putting pressure on household budgets. In the face of rising prices for everyday essentials, from energy to car maintenance, the need for effective solutions to curb these costs has never been more urgent.